And good morning, everyone. Thank you for joining us at our 2022 SEC Roundtable. It still sounds funny to say 2022, but yeah, we're already halfway through January. And for those of you that have calendar year ends, if my math is right, we have 12 days left here and 28 in February, that's 40 and 31. We have about 71 days until the 10K is due if you're a calendar year end. So today we're going to pass on some helpful hints to help that process along for you. We've got a really great program set up for you today, and the slide here is some of the topics we're going to be covering today. So to go through this real quick with you, the first topic we're going to cover is something you might not have heard of yet, and that's called spring-loaded compensation. And so Diane's going to take on that topic. It's an emerging issue that we wanted to share with you today. Next up is going to be Pat, and Pat's going to talk about some views on materiality that the SEC has. And one of the things you'll learn from Pat's session is you'll learn the difference between a little R restatement and a big R restatement. So they are different, and Pat's going to explain that in just a little bit. Wayne's going to walk us through some of the lessons learned from the recently concluded Theranos trial. So Wayne's got some interesting takes on that. The next point on the agenda will be to go through some of the 10K changes. You may know the SEC mandated some changes in the Form 10K for last year and for this year. So we'll walk you through what those changes are to make sure you're aware of them. And then you may know that every December, the AICPA hosts an SEC conference. It's in Washington, D.C. It's in December of every year. The speakers include folks from the SEC, the FASB, all the big four firms are there, the PCOB's there. And so there's a couple of other highlights that we'd like to share with you. And our audit principals, David and Paul, are going to share some highlights, some items that we weren't just able to get into the agenda today, but thought you'd want to know about. So that'll be the last item in our agenda today. We have a lot of returning and friendly faces at this SEC Roundtable, and we're honored to have everybody back again. But we also have a number of new folks that have not attended one of our SEC Roundtable events. So we want to make sure you know a little bit more about our firm. And so just a couple of bullet points to let you know who's bringing this program to you today. So Haskell White, we are a true middle market focused accounting and advisory firm. We work out of two offices. Our main office is in Irvine, and we have another office down in San Diego. We've created a firm that we think is different than most of our competitors. We are a great place to work, and we are a corporate role model working with a lot of different charities. And it's not just our words that say that. We have a really great trophy case that we can actually show you what the folks think. We work with technical competencies and experience of larger firms, and we combine that with the attentiveness and the responsiveness of smaller firms, a solution that we think works well, especially with middle market and smaller public companies. On any given week, you're going to find us working with accelerated filers, non-accelerated filers. We do consulting work on SOX and ICFR matters for non-audit clients. And we also help privately held companies, especially those that are planning a future transaction, whether it be maybe a sale or even an IPO. Our commitment to quality is evidenced by a history of good regulatory inspection reports, our ability to recruit and retain top professionals, and the length of many of our client relationships, many of which span over a decade. So the next slide, we'll go through the presenters for today. So Megan, if you can switch, there you go, thank you. So here's the lineup for today, and I'm not going to read the biographies. The truth is our website is wonderful, HWCPA. You can find some biographies there on the website. But you'll be hearing today from all four of Haskell & White's audit partners. Wayne Pinnell, who's our managing partner. You'll hear from me. You'll also hear from Diane Wittenberg and Pat Ross. We are the four audit partners at Haskell & White. We have two audit principals, David Brownstein, Paul Lewis, and you'll hear from them before the program's over. A couple of things you might notice on this slide that I'll just point out. If you do the math, what you'll see here is over 125 years of cumulative experience. And what you'll also notice is those pictures are probably at least 2 or 3 years old. Batting leadoff today for us is Diane Wittenberg. So Diane is my fellow audit partner, but also a fellow UCSB Gaucho. So Diane, why don't you kick us off with some spring-loaded compensation and some other emerging issues?
Okay, thank you, Rick. Good morning, everybody. We're going to start off, as he said, talking about spring-loaded compensation and some other issues. And I'm going to start you right off with a polling question. So as Rick mentioned, especially if you want CPE, make sure you answer the polling question. So what are spring-loaded options? Are they options that bounce around between different holders? Are they options that are loaded with tax issues and are only issued during springtime? Are they options that are issued just prior to a positive news release, or you have no idea? I think I made this pretty easy, just trying to make sure everybody's paying attention. So go ahead and make your selection. As you all probably guessed, answer C. And they're not just options. It can be any kind of spring-loaded award. And those are awards, it's any kind of compensation where the company grants options or an equity award right before market moving information, like better than expected earnings or a big important transaction, or for all you biotech companies out there, it might be FDA approval or some kind of milestone in your research. So the options, of course, then have the potential to soar once that news is made public, which then provides immediate profits to the executives. Now, on the next slide, I've got a real life example of this for you. Back in summer of 2020, Eastman Kodak stock surged to its highest level in 6 years when it announced that it was going to get a very large loan from a government entity to help fund some making drugs against protection against coronavirus. The day before they made the announcement, they handed out a bunch of options to their executives. Some of those options vested the day they were granted. So they were already vested. And then the next day they make this big announcement. And of course, the stock soared to its highest level in 6 years. Specifically, the executive chairman stood to gain more than $95 million from that increase if he had exercised at the then current prices, which he didn't. So the company wasn't charged with any securities violations because technically this is not illegal, but investors have long considered it to be misleading or manipulative. And the SEC monitors it for potential securities violations. But in practicality, companies have been using this practice for years as a way to quickly compensate their executives. So now the SEC is focusing more on it. Specifically, the SEC chairman, Gary Gensler, said it's important that companies' accounting and disclosures reflect the economics and terms of these compensation arrangements. So in November of 2021, just a couple months ago, the SEC issued some new guidance on how companies should recognize and disclose the costs issued with these awards. They advised companies to fully consider the impact that this significant non-public news could have on the value of the spring-loaded compensation. So what are the specifics of this guidance? What does the SEC want you to do? They want you to consider whether it's appropriate to adjust either your current share price or your expected volatility when you're coming up with your compensation amount. So, historically, we plug in, we're plugging into our Black-Scholes model, the current share price, we calculate the historical volatility and the other inputs, and it gives us the price, and that's what we record. Well, the SEC says, maybe not so fast, maybe evaluate those inputs a little more, and maybe you need to make some adjustments. So of course, that's going to require some significant judgment. And the SEC says, at a minimum, even if you're not going to change your accounting, at a minimum, the SEC expects that you would disclose how you determine that current share price, when an adjustment is required, and any significant assumptions that were used to calculate that adjustment. So now the SEC is saying, look at your accounting, adjust your disclosures, and then of course, the last piece of that is going to be, remember, you need to adjust your internal control over financial reporting policies and procedures as well, both for the accounting and also for the disclosures once you determine what those policies are in regards to these adjustments. So that is the update on spring-loaded compensation. I also wanted to just touch quickly on a couple of other topics from the conference. Revenue recognition and segment reporting. The Office of the Chief Accountant was saying that they noted some recurring themes in accounting consultations, specifically on revenue recognition and identification of performance obligations. They noted that there have been a lot of consultations on whether a performance obligation is distinct or not. And remember that in order to qualify as distinct, it has to not only be capable of being distinct, but it has to be distinct within the context of that contract. So they've had some consultations around that, some around principal and agent analyses. And then when it comes to identification of the customer and consideration of payable to the customer, they've noticed some consultations that it's been difficult to identify those last two items when there's more than one party getting incentives in an arrangement. It's just been difficult to identify. So they have had a lot of consultations around that. And then a takeaway on segment reporting. They noticed there's been some consultations on some segment reporting. You don't want to think it's a check the box, one and done and move on. That's a continual process. Everyone knows that you're supposed to look at the chief operating decision makers' responsibilities and processes when you determine if what your segments are. Well, the chief operating decision makers' processes could change over time. What they're looking at could change, especially as your business changes. So just remember, as the role of that person changes, so should your evaluation of segment reporting. So that is all I have for today. I'm going to hand it over to Pat to talk about the SEC views on materiality. Thanks, everybody.
So materiality, what is it? Why do we care? And who is we? You'll see, there's a lot of stakeholders in the financial reporting process, and the legal profession has a definition with a substantial likelihood that the fact would be viewed by the reasonable investor as having significantly altered the total mix of information available. One of the Supreme Court issues. The auditors also have, the AICPA provides them with the definition. Won't read everything out there. The preparer community, the accounting profession, the FASB also has a definition. Focus on this one. The omission or misstatement of an item in a financial report is material if, in the light of the surrounding circumstances, the magnitude of the item is such that it is probable that the judgment of a reasonable person relying on the report would have been changed or influenced by the inclusion or correction of an item. Kind of a run-on sentence there that the accounting profession tends to gravitate towards. Also, the SEC, they're kind of almost the final judge and jury here for the most part in evaluating how the materiality gets viewed. There's a little more simple, definition there of those matters, which there is a substantial likelihood that a reasonable investor would attach importance. So, if you kind of read through the definitions, there's some definite themes, but, they're very subject to interpretation. with the preparer community, you guys preparing your 10Ks, how do you determine materiality? Is there one person in the group there that figures it out, or is it a kind of a group decision? It should really be driven by what your investors think, and put yourselves in their shoes. If they're the main users of the financial statements, what do they consider material? We'll go on the next slide. So again, materiality is not all about the numbers, and there's a concept which the SEC views of in actually the accounting profession of qualitative versus quantitative, and such straight quantitative measures or rules of thumb is hey, if it's less than 5% of net income, then it's not material. That can't be the only assessment, and you can't stop at just that quantitative measurement. There also is an element of what's called qualitative. So something number wise might be small, but it might have a material qualitative impact on the financial statements. The SEC's guidance list out the bullet points there. I won't go through all of them, but if you kind of consider some of those, does the rather small dollar amount of an error change trends in earnings, or do we go from a loss to a gain if we really got a thin profit margin? Or is it something buried in a segments? If you have multiple segments in your company, but one of them's more the big profit leader, does a small error in there really influence the decision makers or the users of the financials if all the other divisions or segments are break even? Thing we run across a lot is loan covenants. If you default on your loan covenant, that tends to have a very big impact on the organization if your debt could be called. So, if it's, maybe a couple $1,000s either way, and you're either, meet that tangible net worth covenant or you don't, that could be a material impact for the company. And again, this list isn't exhaustive, and there's, one of the assessment tools we use has 19 factors that consider of what's qualitative. And if you guys in your practice think of anything else that could be inclusive here, if you want to dump it in the chat room to share with everybody, but it has to go beyond what just the numbers tell you is a quantitative assessment of whether a transaction or error could be material. So next slide, a little polling question here. It's permissible to use a standard rule of thumb measurement, such as 5% of net income, in assessing materiality, as long as we disclose it, true or false. All right, I think we probably got the answer here, and it's actually false. I wrote this polling question and thought it would be really easy for everyone. And then when I was kind of going back through my slides and notes, I said, well, maybe that's not too black and white of an answer. If you think about the definitions and what a reasonable person thinks and who's the user of the financials, that's a broad range of people. You could have really institutional investors that, could be, the pension funds, or it could be the, sole retail investor. So maybe if you tell them what your definition of materiality and what you did, maybe that's not a bad way to go in the future. I don't know, but but I think the SEC today would still view, you have to go through those qualitative assessments. So a couple further considerations. Just be mindful of a series of small intentional misstatements. Managing earnings, not one thing might, cause some heartache, but if you start having a series of intentional errors, it could run you afoul of maybe some of the books and records provisions the SEC kind of holds the users or the preparer community and companies accountable for. Assessment of individual misstatements themselves and in the aggregate. So if you have a number of errors, you need to kind of look at those all added up together. We generally see, one small error, and then there's another one, it's additional expense, and another one's additional expense. Well, if you add those up over time, they might make a material effect on your financial statements. As auditors, sometimes we get accused of, finding errors and misstatements all going one way to the negative and not finding revenue or other income. But we do, keep an objective approach to that. And if we do see, positive accounting misstatements, we kind of have to aggregate those together and see what they net out to. But also, if they do net out, is that okay if the net income isn't materially misstated, but one particular line item like revenue or SG&A is materially misstated on its own? So you do need to kind of take a holistic approach and look at any errors you identify individually and into the aggregate and how they affect the overall financial statements. So as I think Rick mentioned in the intro, evaluation of errors in prior periods come up. We kind of, the community has called these, little R restatements, is, just adjusting your prior year financials when you kind of do your current year audit because you ran through something where you found an error in the prior year and don't want to go back and amend the prior 10K and file an 8K saying you can't rely on our financial statements and amend all the Qs, and going through that process, which tends to, kind of have a detrimental effect to the stock price and the overall, financial reporting credibility with the company. This has been a trend over the last couple of years. The SEC has seen a lot more of these, and they have emphasized it's, you need to be objective in evaluating whether an error is material. Also to consider the effects on your internal control over financial reporting. If you're in your current period financial close cycle and you discover an error that you didn't catch last year, do you still have a control deficiency that you need to evaluate for disclosure as a material weakness? Also, the quantitative effects, as they increase, it gets harder, as that dollar amount gets higher, it gets harder to, argue away the qualitative aspects of why that error isn't material from the prior year. And really from, a lot of the arguments that people make is really the passage of time. Hey, it was last year's financial results. It's in the rearview mirror. Where the investor community is looking forward. Here's our current period. It's not really a lack of, the relevance of that prior information isn't important. And they've kind of, the enforcement division kind of doesn't wholeheartedly buy that as one argument, because, people look at historical financial statements and trends. So they want, the prior years to also be correct when they, have some integrity in the financial reporting. All right, just a couple closing thoughts here before we go to the next presenter. As auditors, we deal with this a lot. I would say absolutely every single audit, but the vast majority do have errors in them that either we discover or the client discovers as you go through the close process, and evaluating those in the aggregate individually and what's qualitative. And we go through that all the time. So, we encourage our clients to have some upfront discussions on that. Hey, can this potentially be material? Where's this going? What qualitative effects should we think about? So, so it's a open discussion we like to have, and not, hold all our cards to the end of the audit committee meeting and come out with, well, here's the misstatements. That's just not a very good approach to getting the best answer for our clients and the users of the financial statements. The desire to avoid a restatement at all costs can't be the driving principle. The SEC would kind of expect you to be objective in going through a thorough assessment process before you reach a conclusion, and not have the conclusion and try to back yourself into it. And then future applications of materiality as we get into more ESG type disclosures and that type of thing. And, are you zero carbon, or what's your carbon footprint? how do you measure the materiality of, whether you're zero carbon or not? Is it, negative 0.5 or yeah, there's not a whole lot of numbers going into that. So that's probably going to have to evolve over time, as the disclosure rules continue to evolve. All right, with that, we'll close up our materiality discussion and move on to our next presenter, Mr. Wayne Pinnell.
Every now and then we like to cover something that's, I would say, ripped from the headlines. And this is a story about a company that started 18 years ago, reached a couple climactic points here recently. And we'll walk you through this thing. It's an interesting tale. And having taught auditing for years at the university, I always like to have a good fraud story. And now it's nice to have another newer one, because the one I was using, quite frankly, from the 1980s was a little dated. So this particular story, Theranos, has all the makings of a good movie. It has sex, which we don't often say in an accounting presentation here. So Megan, you need to click the transition so you're keeping up with me. Okay, it has sex, technology, lies, politics, celebrity, and of course, greed. And so what we have here is a story of a company that was founded by a young wonder kid, Elizabeth Holmes, and what happened over the lifespan of this company. So we have a good cast for this upcoming movie. We have a founder. Elizabeth was the son, I'm sorry, not the son, she's the daughter. She's the daughter of her dad, who was coincidentally a vice president at Enron. So I'm not sure that you would say this stuff runs in the family, but she does have ties to Enron, certainly one of the larger fraudulent transactions from the early 2000s. Her mom was very tied into the congressional staffing arena. She was a congressional staff committee staffer. Elizabeth knew when she was in high school that she wanted to be an inventor. Apparently, she just pursued that dream. She went off to Stanford eventually, where she started her college career. Somewhere in that timeline between high school and starting college, she did meet Sunny Balwani, which I'll come back to. But in developing her idea, she had an idea that would take a much simpler, faster approach to testing blood samples. And so you'd no longer have to get them from an intravenous, vein type access where they take tubes and tubes of blood. She was able to do it, as she would argue, with just a couple of drops of blood and drop it into this machine. Of course, so we have the founder, Elizabeth, and we have the lover, Sunny Balwani, actually became her COO, president of the company. She first met Sunny, who's 18 years her senior, when she was in high school, and he was studying up at Berkeley. And his studies were mostly around computer science and some engineering and things like that. But when they started the company, Sunny gave up his studies in college at age 37. He gave up his studies and he joined the company. And those two had an affair that lasted over a decade, which was never disclosed to the investors. Most of the people in the company didn't know. There were lots of suggestions, perhaps, that something was going on because they left the company at the same time, arrived at the company at the same time in the morning. They often took investor trips, et cetera, together. So the technology was, that little picture of a box there was called the Edison. She named her product after Thomas Edison, the famous inventor, light bulbs, et cetera, and was using that as an idea of the 10,000 tries, and you get it right on the 10,001st attempt. Over time, 10 years of time, the Edison never quite worked. And an employee, the whistleblower, Tyler Schultz, who was working in the lab, he is actually a family friend of Elizabeth Holmes, who was a friend of his grandfather, George Schultz. He went to work for her. He was so excited about this opportunity that he asked during a family meeting if he couldn't intern at Theranos and see this thing get developed. So when you look at George was one of several government contact type folks that was involved with Theranos, and George was invited to be on the board, and he was very much a supporter of Elizabeth. He was able to get her into meetings around the country with different folks. And if you drop down to the bottom of that side, you'll see there are other government notables that are involved in the company as well, including Henry Kissinger, Senator Sam Nunn, and General Jim Mattis, all of whom were serving on her board. So we'll have a little bit of background on that story when you get to the end. But her board was the who's who, mostly of government officials. So the investors she went after were, really smart people, a lot of famous people that put lots of money into this company. And they included folks like Rupert Murdoch, pretty well-known media mogul investor. Betsy DeVos, you recognize her as the recent Secretary of Education, but also she's from the DeVos family, which is one of the two families that started Amway many years ago. The Walton family that started Walmart made some investments. And Tim Draper, who is a venture capitalist from the Bay Area with Draper Fisher Jurvetson, was one of the earliest investors, as he has been known to be in a lot of technology companies that spring up in Silicon Valley. So just a real quick polling question here on the next slide. Did anybody hark back into history and recognize which president for whom George Shultz served as Secretary of State? Drum roll, please.
There you go.
And I looked down and I missed it, but I know the answer is Ronald Reagan was for whom he served. So when you take this movie, we've got a story, we've got a cast, and now we look at really the plot of this whole thing. So Elizabeth was just 19 when she founded this company back in 2003. She was noted to be very charismatic. She could recruit people to her story. She had a high profile batch of supporters and investors, as I noted, and an apparent cult-like following by her employees based on a couple other things I'll share with you. Sunny Balwani joined her in the company's effort, but Sunny had, as the COO president, he had no training in anything bioscience or medical. In fact, he often was noted as misusing technical terms. And there's a story out there that he didn't understand what they were doing. And he would say things like, and I'll have to read this little quote for you here, but the invention, the Edison blood testing device, is going to be way up there with the discovery of antibiotics. He once misheard, so antibiotics and the medical device don't seem to really jive together, but he misheard the word end effector, which was a claw device at the end of the Edison machine, and he heard it as endofactor. So not end effector, he heard endofactor, which is a nonsense word that he kept repeating throughout presentations. And the people around him had built a joke around this. They actually stuck the word endofactor into some PowerPoint presentations, and he didn't even notice that was going on to be wrong. So as I mentioned, the two of them, Sunny and Elizabeth, were involved in a relationship for some 10 years while they went about raising dollar after dollar, in fact, hundreds of thousands, millions of dollars to affect this story. Now, Elizabeth has a very strong storytelling aspect to her. So she would tell people why this machine was going to be so important. It would change your lives. You'd be able to not only get a blood test once a year when you went to the doctor, because it was such a small thing, you could actually get a blood test daily if you wanted. Her dream was an Edison machine on everybody's kitchen counter, if you will, that people could actually build their own history of their medical ailments as they went. And rather than be surprised because they've got an advanced stage of cancer, they might actually find a way to early detect it. So a very strong story built into this led her to raise more than $700 million from venture capitals and private investors. And at one point in 2013, 2014, it did have a market valuation as a private company of $10 billion. So she owned more than 50% of the company. So, on paper, she had a pretty nice built up wealth in there. But all was not perfect. The machine didn't work, and is the end of the story. The machine didn't work. They built up a process with Walgreens on a growing contract to set up Theranos testing centers inside Walgreens stores, starting in Arizona, where they were able to change a law in Arizona to allow patients to request their own blood test. And that's different because most times if you get a blood test, it's something that your doctor orders, not something you could just order up for yourself. And the testing changed over time to where they were not seemingly taking the little samples anymore. They went back to intravenous samples, and Walgreens began to wonder why these samples were getting larger. It wasn't what they had promised. And lo and behold, they started double checking some of these samples against traditional lab testing, such as those at LabCorp and Quest Diagnostics and others. And they found the results to be very, very different. Enter Tyler Schultz again as a whistleblower. He approached Elizabeth on a couple of occasions and said, this doesn't really seem to be working. And one thing he noted in an interview was that he saw it fail every day. He saw the machine get stuck. It was messy. It didn't work. But even when he was working with the product, seeing it fail time after time, he would go have a 5-minute conversation with Elizabeth and feel like he was saving the world again when she was done talking to him. She could turn him around that way and get them convinced that they were all working for the greater good in this process. So Fortune had done a nice article on this up and coming rising star of Silicon Valley, and the whistleblowing action came about. Wall Street Journal started doing an investigation. More of the medical research started invalidating the claims they were making. And by 2015, just a short time after they hit their high point of value, the company declined like a rock and faced a number of lawsuits and ultimately was dissolved in 2018. So the lawsuits that came about, a couple of them just came to conclusion here recently. If you go to the next slide, Megan. Elizabeth was found guilty just on January 3rd, just a couple of weeks ago. 4 counts of fraud, 3 for wire fraud, 1 for conspiracy to commit fraud. To be fair, there actually were 11 charges. She was found not guilty on 4, and there were no verdicts on 3 others. And so at this juncture, she's currently awaiting sentencing. Sunny Balwani, her president, COO, former relationship partner, was supposed to have a trial that started coincidentally January 11th, just a week after her trial ended, but that has now been rescheduled twice out till March. So we have to stay tuned and see what kind of result happens there. But the expectation, of course, with Holmes having been found guilty, that probably makes his story a little bit harder to reach a different verdict, if I'm going to predict here. So we get to the story, then we get to the epilogue. So what do we get out of this case? It's really easy to look at things on Monday morning and see these things in the rearview mirror and say, how did anybody fall for that? But when you look at what was going on here, there's a company that built a board that had no experience whatsoever in the bioscience arena. Elizabeth herself didn't have bioscience. She really didn't have any kind of medical training. Sunny Balwani had no medical training. So they really were working from software and engineering. They missed deadline after deadline after deadline in the production process, but they just, told their next story as to why this was happening and raised some more money. They had a number of unhappy business partners in the process. Walgreens is a huge story of what they were doing. Walgreens really invested a lot to make these things work in their stores. Safeway was looking at doing the same thing. And the sad part of this, there were a lot of blood tests that were used on patients, many with mixed results. They did research for GlaxoSmithKline, Pfizer. Of course, they did a number of tests for Walgreens. Ultimately, part of the settlements, they refunded all of the patient charges for the testing at Walgreens. Many of them were erroneous. They just did not measure up to other things. So they fooled, typical fraud story, right? They fooled people. They fooled well-known companies for many, many years. Created a family rift between George and Tyler because George was such a supporter of Elizabeth and her ideas and the company's growth. And he just did not believe Tyler when he told him the story time and time again of what he saw on the ground inside the company. And ultimately, sad note, it took Tyler a couple of years to convince George that he was right. And he was able to do that before George passed away last year. So the commentary that's come out of this, so you see it in a lot of places, is Silicon Valley has a fake it until you make it attitude. It's something that's coming out not only through this story, but through other press things. And of course, we've got the caveat emptor, buyer beware, still alive and well. The interesting note here, she named it the Edison, as I mentioned, after Thomas A. Edison, the inventor of the light bulb. Thomas Edison is actually attributed as being one of the original fake it till you make it inventors. In fact, Menlo Park, California, where he created the light bulb, he was having trouble getting the lights to stay on, literally. He had trouble getting that filament in the middle of the light to survive the charge. It kept burning out. He kept telling the story to people that it was working. He kept raising money. In fact, as the story goes, he was almost out of money when he finally got the light to stay on and proved that it worked. So it's gone on for years in terms of how people go tell their story. And maybe sometimes they've got a goal out there and there's the hope they're going to get there, but it's the storytelling that gets there. And so in the words of another famous philosopher, Homer Simpson, it takes one to lie and one to listen. And what we can look at this is say Elizabeth certainly had a lot of listeners. So I teed this up as kind of it would make a great movie, and a couple of chat comments have already commented. In fact, yes, it is a great movie. There's a documentary on this story that is available on HBO. I actually watched it last night to catch up on all the little tidbits here. Really well done. I will tell you, it runs 2 hours. So if you want to sit down and see this story, my wife, who doesn't always get into these things, she enjoyed the movie, but her comment was it was kind of long. So, but not to be undone, there's a full-length feature film coming as a result of this story. Jennifer Lawrence has been cast to play the part of Elizabeth Holmes. So Bad Blood, Secrets and Lies in Silicon Valley is actually being produced as an Apple original film. And it's very ironic to conclude on this point because Elizabeth so much wanted to be like Steve Jobs. He was her hero. In fact, she dressed like him. She had a closet full of black turtleneck sweaters, and that's pretty much what she wore every day. So just a story out there to keep it fresh and for people to understand that, it's not always what it seems. The investors were wooed by a story. They were wooed by empathy to a cause. Very little financial information was ever shared. Very little actual observation of the equipment was ever allowed. And so as a private company, they were able to keep secrets for a very long time while they tried to make it work. So with that, let me conclude there and pass it over to Rick.
All right. Well, thank you, Wayne. And so Megan, let's go ahead and jump into the next section of our presentation. And, here I can assure you, we will not be talking about sex and we will not be talking about greed because we're going to be talking about a 10K and some of the information that goes into the 10K. And so there's been some significant changes in the last couple of years that we want to make sure everybody's aware of. So I've got a number of bullet points to go through. So I'm going to ask your forgiveness early as I run through these. So please fasten your seatbelt because we will go through these items fairly quickly to keep us on track with our agenda. So I think the best way to look at these 10K changes is really put them into two different groups. We had one group of changes that went effective for last year's 10K. So if you're a calendar year-end company, these changes were required in your 2020 10K. And now we have the second group of changes for the 10K. They're going to be required to be implemented in this year's 10K. So first, let's go ahead and take a look backwards and let's look at what should have been implemented last year. And let's just make sure that we're clear on those requirements. You'll see on the slide, there's 3 bullets, and they are human capital management disclosures. They are some revisions to risk factors, and there is some new guidance on the business section and legal proceedings sections in your 10K. So a couple words on the human capital management. This, I think, was probably the most squishy of them all, but this was the requirement to include a description of human capital resources and human capital measures or objectives that a company might focus on in managing its business. So for example, how do you attract, develop, and retain personnel? And I think especially today when we're all experiencing the Great Resignation, there's a high degree of turnover in most businesses. There is some issues in terms of hiring qualified folks. So this is certainly relevant for today. So there was actually a survey done this year on the S&P 500 companies in terms of what type of maybe new human capital metrics they were disclosing in their 10Ks. So what can we learn from the trends? And the survey showed that companies were disclosing things like your geographical distribution of employees, the breakdown of types of employees, full-time, part-time, seasonal. What steps have been taken to identify, recruit, and retrain new and existing employees? Diversity statistics, and what are the company's commitments to diversity and inclusion? Of course, employee incentives and benefits, employee safety measures, and employee engagement surveys. So those are all things that S&P 500 companies are disclosing around this human capital measurement requirement. Right now, it's largely principles-based, so there are not prescriptive rules in terms of what you have to disclose outside of the number of your employees. But it's going to be interesting to watch now because, as you know, there is now a Democrat at the head of the SEC. So again, there's 3 Democrats, there's 2 Republicans on the SEC. So some folks are speculating that we might get more prescriptive rules in this area prospectively. So we'll keep an eye on that, but let's make sure that we are including those human capital disclosure requirements. Risk factors. So risk factors was new last year. So what did we do to the risk factors? Well, what the SEC is trying to do is really streamline the disclosures here. So there's a new rule now that says if your risk factors are more than 15 pages in length, we want you to include a summary. So you've got to include a little bit of a Reader's Digest version or an executive summary of those risk factors. So the SEC is trying to motivate us to keep those risk factors short, keep them under 15 pages. And again, if you don't, you're required to list a summary there. The SEC is also telling us, please tailor general risk factors specifically to your company, or just place them underneath a general heading. So again, they're trying to go with specific disclosures, not general risk factors that quite frankly can apply to any business. Of course, this is going to create some interesting conversations with your securities counsel. In our experience, securities counsel tend to like to throw everything but the kitchen sink in the risk factors. But again, the SEC is advising us, hey, let's be real specific with these risk factors. The third change that we had on the risk factors was to use some headings to organize them. So the risk factors should be presented in an organized manner. So maybe we group them as how these risk factors relate to our business. Maybe we have another grouping for how they relate to our industry. Maybe we have another grouping how they relate to the ownership of our stock. But again, we want to organize them properly. There's a couple of warnings that the SEC has given here, and they've made some cases out of a couple companies. So one warning that the SEC has given us is beware the hypothetical disclosure. So sometimes a risk factor would say we may have a security breach, or a security breach could occur. And the problem arises when those events have already happened and you're positioning your risk factor in a more hypothetical sense. Yahoo is the poster child for this one. Yahoo disclosed something like there may be a risk of data breach when they actually already had one. And the SEC fined them a handsome $35 million for that. So we want to be aware of that. The other warning the SEC has given us is beware of the COVID-19 disclosures. We are now well into COVID-19, and so the SEC is advising us that the disclosures here should be robust and specific. COVID-19 is no longer a novel consideration from a disclosure perspective, so we need to be real specific. One company's already gotten in trouble for this, and that is the Cheesecake Factory. This is all public information, so if you wanted to look at an interesting case, look at the Cheesecake Factory. When COVID hit and they went to a delivery and a to-go model, they made that transition appear much more rosy than it actually was. The company was losing a lot of money, and they didn't really disclose the stress on the business. And so they ended up paying a fine to the SEC. And that was, I think, the first COVID-related enforcement action that we saw. The last item here is just on the business section, and quite frankly, there's not a lot of new information here to pass on to you. One thing that is worth mentioning is the legal proceedings section. And again, the SEC is trying to streamline. So let's make sure when we go to legal proceedings, let's take advantage of the opportunity to use hyperlinks and cross-references. So I think a best practice would be to do a nice description, maybe in the footnotes to your financials of the legal proceedings, and then we can reference into the 10K and maybe even the MD&A where it's relevant, or maybe the risk factors where it's relevant. But we are allowed to use cross-references and hyperlinks now. So that's a nice benefit. Let's go to the next slide, and here's a couple of improvements for 2021. And again, the theme here is going to be on streamlining and making the document a little bit more easier to digest. So we're getting rid of a couple things, which is really nice. So right now, if you are not a smaller reporting company, you're required to include a financial data table that goes back for 5 years. So we're getting rid of that. All that information is readily available, so there's no need to duplicate it here. And also, if you're not a smaller reporting company, you're required to include in your financial statements a disclosure of your quarterly financial data. So the SEC asks you to print your revenue, your gross profit, your net income by quarter. And so again, that's information that's readily available to most investors. So the SEC says, let's get rid of that. So 2 items that we're getting rid of there. The big changes for this coming up year are all about MD&A. And Megan, if we can go to the next slide. So we have what we'll call a new and improved MD&A. Again, we're going to eliminate some of the disclosure requirements that are in MD&A today. So that contractual obligations table that shows our contractual obligations going out over the next 5 years and thereafter, we're getting rid of that. The section for off-balance sheet arrangements, we're getting rid of that. Although the SEC warns if any of those, the off-balance sheet arrangements, the contractual data table, if that information is important to users, please include it in your MD&A. Critical accounting estimates. It might surprise you to know that that is actually not in the SEC rules right now to include critical accounting estimates. Most every public company discloses them. So it is now official and it is now required and it's in the SEC rules. So that was added. The SEC is going to focus on known trends and uncertainties. This is an emphasis point in MD&A. So what are the known trends and what are the uncertainties in your business that might change your financial picture going forward? So they're going to emphasize that area. Probably the most important one, and I think the one that's most interesting, is how we present the MD&A, the results of operations section. So today, as you might know, the requirement is to present really quarter over quarter or year over year. So we'll look at this quarter versus the same quarter last year, the year-to-date period this year versus the year-to-date period last year. The SEC has given us an option now. So we can continue to do that. Or the SEC says, if you'd prefer to run your results of operations comparison based on sequential quarters, you're allowed to do that. So if you wanted to compare this quarter, not to the same quarter last year, but to the immediately preceding quarter, we're allowed to do that now. So that's something you probably want to talk about in your company and see if you want to avail yourself of that option. There are some transition requirements if you choose that, so be aware of that. But it could, especially if you're a rapidly growing company and comparing Q1 of this year to Q1 of last year means nothing, why not do a sequential quarter over quarter presentation? That might be more useful for the investors. So that's a big change, and I think probably one of the more interesting ones. Megan, let's jump to that polling question real quick if we could. And so we have a polling question just to check the temperature in the room. If you think about your own company's 10K, what do you think of the length of the document? Is it too brief? Do you think it's too voluminous? Or do you think it's Goldilocks and it's just right? So we'll give you a second to think about that. And Megan warned me, she said, hey, you better have something to talk about while we're going through the polling question. And I was hoping to find some data on the length of 10Ks. And the best I could find was a Wall Street Journal article from a number of years ago that said the average 10K had about 45,000 words in it. And this is about the maybe 2015, 2016, the study was done. So about 45,000 words in the average 10K. And just as a reference point, the book, The Great Gatsby, has 49,000 words in it. So it's about reading an average 10K is about the equivalent of reading The Great Gatsby.
So you should be seeing the results, Rick. Right
Yeah,
now.
and I think, nobody voted, very few people voted too brief, which we'd expect, and voluminous. And so again, I think some of the stuff we're talking about today is really meant to cure that. The last slide we have, Megan, if you can go here, the last slide is just a couple other of helpful hints as you work through this 10K season. One is just be aware of SEC comment letters. There's lots of folks that comment and write articles on what the SEC is reviewing. This helps you because you know what the SEC is focused on, and it helps you understand what companies are having trouble with. The number one area of SEC comment letters for 2021 was non-GAAP financial measures. And so be aware of that. And again, this information is publicly available, but it's a good practice to read through it. A popular term that we've been hearing a lot lately is something called director overboarding. The proxy advisory firms, ISS and Glass Lewis, are promoting and they're monitoring how many boards your directors are serving on. And they've come up with some metrics. So for example, if you're a director, these advisory firms say you really shouldn't serve on any more than 5 boards. And if you have a C title, if you're a chief executive or a chief financial officer somewhere, they only want you on 2 boards before they think it's too much. So just be aware this is an area of increasing scrutiny. The last item here, just on ESG, and we purposely didn't put ESG on too high of a platform today, but this is an issue that's not going away. It's a heavy emphasis area from the SEC. We are going to see some rulemaking from the SEC around some mandatory climate-related disclosure requirements this year. So the rules are being written, they are coming. So please don't think because you're a small company that this is not applicable to you. There's rulemaking coming this year, so we'll stay tuned for that. So that's all I have. What I'd like to do now is just introduce David Brownstein and Paul Lewis. As I mentioned at the onset, there was a really great conference in Washington, D.C. that took place in December. And there was a couple other highlights in there that we really didn't get to in our materials today. So I'm going to ask David Brownstein and Paul Lewis if they could join us now and just say a couple words about maybe some of the highlights that they picked up from that conference. David?
Thanks, Rick. I'm David Brownstein. I'm a principal at Haskell White. I'm here with Paul Lewis, who's also an audit principal. Our partners each just did a great job summarizing a topic from the AICPA SEC conference, but there were about a dozen other topics that were discussed at the conference. So we're going to call this the lightning round. Paul, of the remaining dozen or so topics that were discussed, what was your #1 topic that you think our audience should be aware of today?
Thanks, David. Well, there were a lot of other interesting topics discussed, and it's hard to pick. If I have to pick one, I'll pick cybersecurity as an item to discuss. And just an FYI, cyber attacks have increased by about 33% since 2022. Cyber risk poses not only operational risks to organizations, but also risks to the financial reporting process. I know this matter is a top agenda item for many boards. When the cyber security breaches occur, you should first identify the deficiencies that enable the breach and would then evaluate whether the deficiencies are relevant for your internal control over financial reporting. Companies should focus on technology and talent. David, the conference ended with some forward-looking items that may not, or may be on the agenda for the SEC 2022 conference. Can you tell us more about that?
Yeah, well, I've got some good news and maybe some not as good news for our audience. I'll start off with the topic that might create just a little bit more work for our audience, and that's disaggregation. Investors are really looking for more disaggregation of financial information so that they can get more meaningful insight into companies' performance. Some examples that were discussed included disaggregating income and expenses by fixed versus variable and recurring versus non-recurring. Also disaggregating information by geography to help investors identify future risks. The good news is there was also some discussion around eliminating unnecessary complexity. Specifically, the discussion was around making the consolidation guidance a bit less complex, as well as revising some of the debt versus equity guidance, both of which I know our clients deal with regularly. Finally, I'll end with the great news, and that's if your company is struggling with any of the topics discussed today, or any other topic for that matter, the team here at Haskell White stands ready to assist your team 24/7.
Since we are at 9 o'clock, why don't we go ahead and end our program now?
Okay.
Again, if you have a question in the chat room that we didn't get to, one of the Haskell White team members will reach out to you and we will address those questions. I think a lot of you have our email and contact information, so you're always welcome to reach out to us that way as well. But why don't we go ahead and end our program here. David and Paul, thank you for that overview. Pat, Diane, Wayne, thank you for that. Megan, thank you for the coordination. So I think we'll go ahead and say thank you to everybody for attending our first roundtable this year. We hope to see you all in person soon. Thank you for attending and have a great rest of your day. Thank you.